Welcome to the deep dive. Today, we're tackling a decision that is, well, it's absolutely critical to your long-term wealth, but for most people, it feels like wading into a swamp of jargon and complexity.
It really does.
We're talking about how to find, and maybe more importantly, how to vet a trustworthy financial advisor.
It's a huge decision.
Mm.
Genuinely one of the highest stakes choices you can make with your money. The information out there is just so overwhelming.
Mm-hmm.
And the wrong choice can lead to, years of just okay returns, or even worse, getting sold products you absolutely do not need.
Exactly. So our mission today is to cut through all of that complexity. We're going to distill this whole challenge into a clear, actionable roadmap,
A shortcut, basically.
a shortcut. We've sifted through the noise, and our goal is to lead you straight to the one key differentiator you absolutely need to get your head around.
And that is the concept of a fiduciary advisor.
Before we get there, though, let's quickly frame what an advisor even does.
Good idea.
Yeah.
I mean, on a basic level, they're there to help with everything from specific money challenges, building a budget that actually works, to really high-level tax strategies and long-term investing goals.
Right. And some will manage your entire portfolio for you, while others are more focused on just giving guidance and planning advice.
Precisely. But that brings us right back to the most important starting point. It's not about their credentials, not at first.
It's about who they ultimately work for.
That is absolutely correct. Before you look at anything else, how long they've been in business, their track record, anything, you have to understand the standard they operate under.
And this is where that aha moment comes in.
Yeah.
The difference between a fiduciary and, well, everyone else.
This is the non-negotiable step. Because this one distinction dictates whether they are legally working for you or if they're basically working for a sales commission.
So what is a fiduciary exactly?
A fiduciary is legally required to act in your best interests at all times. It's the highest standard of care in the entire industry. It means the advice they give you has to be unbiased, and they have to put your financial well-being ahead of their own profit.
I hear that definition a lot, but can you make that more concrete? What does that look like in practice?
Okay, perfect example. Let's say a non-fiduciary advisor recommends a mutual fund for you. It's a suitable fund. It fits your risk profile.
Suitable. I hear that word a lot, too.
Exactly. But let's say it's their own firm's proprietary fund, and it has a fee that's, say, 0.5% higher than a nearly identical fund from another company.
Right. Is that allowed?
For them, maybe. Under that lower suitability standard, as long as the product is suitable, they've met their obligation, even if they get a bigger commission for selling you the more expensive one.
Wow.
But a fiduciary could not make that recommendation if a better, cheaper option exists, because their job is to maximize your outcome, not their own paycheck.
That one distinction is just priceless. It's a legal firewall protecting you from being sold something that's just good enough.
And that's why the search has to start and end with that fiduciary commitment.
So how do we structure this whole search process?
We can simplify it. Think of it as a 7-step guide. First, you define your goals. Then you research the different types of advisors.
Which we're doing now.
Exactly. Then you check credentials, compare their fees, interview at least 2 or 3 finalists, and then, this is key, verify their background.
And finally, make the decision and keep an eye on the results.
That's the roadmap.
Okay, let's jump to step 3 then, checking credentials. Because once we've established they have to be a fiduciary, we also need to know if they're actually competent.
Right. The letters after their name aren't just for show. They prove that someone has gone through rigorous study and testing, well beyond just common sense. You need to know what that alphabet soup actually means.
Let's break down the big 3. First up, the one almost everyone has heard of, the CFP, or Certified Financial Planner.
The CFP is your financial general practitioner. They have to have a bachelor's degree, get thousands of hours of experience.
I think the source said over 6,000 hours.
That's right. And they have to pass a really comprehensive exam on everything from retirement and insurance to estate planning. And they have to adhere to strict ethics guidelines.
So they see the big picture, they make sure all the pieces of your financial life, your debt, your savings, your investments are all working together.
Exactly. They're the GP.
Okay, second credential, the Personal Financial Specialist, or PFS. This one sounds like it has a heavy tax focus.
It does. This is a great one if your tax situation is complicated. To even get a PFS, the advisor must already be a CPA, a certified public accountant.
Oh, okay, so that's the baseline.
That's the baseline.
Yeah.
Then they add on financial planning education and pass another exam. So if you're dealing with, business income, complex real estate, or trying to manage capital gains, a PFS really signals a deep understanding of the tax side of things.
Makes sense. And number 3, the Chartered Financial Analyst, the CFA.
The CFA is the specialist, the investment chemist.
Ah, I like that.
This is all about the quantitative side. Investment analysis, valuing assets, portfolio management. It requires passing 3 notoriously difficult exams and getting a ton of professional experience.
So if my main goal is really complex portfolio construction or trading strategies, the CFA is the person I want.
That's the one. They speak that language fluently.
So it's not just about finding an advisor with letters after their name. It's about finding one with the right letters that match what you actually need.
Precisely. If they're an expert in managing huge stock portfolios for executives, but you're a teacher trying to figure out your pension.
Their credential might be fantastic, but not for me.
Exactly. The alignment is key.
And that brings us right to the money. Step 4 in our process. Following the money, comparing how they get paid. This ties right back to those conflicts of interest we talked about.
This is non-negotiable. You have to understand the 3 main ways they get paid before you hire anyone.
Okay, let's break them down. First, the one that's most likely to have conflicts. Commission-based.
Right. This advisor earns money by selling you products. Think annuities, certain mutual funds, insurance policies. Their paycheck comes from the company whose product they sold you.
So this is really best for someone who knows they need one specific product and they're okay with the advice being tied directly to a sale.
Yes. You just need to go in with your eyes wide open.
Okay, second model. The one our sources really recommend as the gold standard for unbiased advice. Fee only.
Fee only. This is the cleanest model. These advisors charge fees directly to you, the client. It might be an hourly rate, a flat fee for a project, or a percentage of the assets they manage for you.
And the crucial part is their income is not tied to selling you any specific product.
Not at all. Their incentive is purely to give you the best advice for your situation, because you're the one paying them directly.
It removes the temptation.
Ah.
Okay, and the third one. The one that sounds good but can be tricky. Fee-based.
Ah, the hyphen. That little hyphen makes all the difference.
Fee-based sounds a lot like fee only.
It does. And that's the danger. A fee-based advisor can charge you direct fees, but they can also earn commissions from selling products. It's a hybrid.
So they can put on their fee hat for one part of the plan and then switch to their commission hat for another part.
And that's where the conflict can sneak back in. You have to be incredibly careful and ask a lot of questions.
So to be safe, the recommendation is to stick with a fee-only fiduciary advisor. It's the simplest way to ensure their interests are aligned with yours.
Absolutely. The way they're paid should never, ever be a mystery.
Okay, that leads us right into the interview. Step 5. You've found a couple of qualified fee-only fiduciaries. Now you need to stress test them.
Right. And luckily, we have a list of 9 critical questions from groups like the National Association of Personal Financial Advisors or NFPFA.
These are the questions that cut through the sales pitch.
They get right to the heart of trust and compensation. You have to ask them.
Let's run through them. First and most important, straight up, how are you compensated?
And if they say fee-based, the follow-up is number 2. Do you itemize commissions, if applicable? You want to see every single penny.
Third, do you accept referral fees? You need to know if an insurance agent or a lawyer is paying them to send you their way.
Fourth, and this one is so critical, are you held to a fiduciary standard at all times?
Why at all times?
Because some advisors are only fiduciaries for retirement accounts, like a 401k, but not for your other investment accounts. You need that commitment across the board. 100%.
Wow. Okay. Fifth question. Are you willing to sign a fiduciary oath?
A verbal promise is nice, but getting it in writing, a signed document stating they will always put your interests first. That's the real safeguard.
If they hesitate on that, that's a huge red flag.
The biggest.
Yeah.
Sixth, have you ever been disciplined by the SEC or FINRA?
Basically, have you ever gotten in trouble?
Exactly. You need to know if there's a history of client complaints or unethical behavior.
Seventh, do you provide full-service financial planning or just investment management? This helps you know if you're hiring the GP or the specialist.
Faith, do many of the clients you work with fit my profile? You want someone who has experience with people in your specific situation.
That makes a ton of sense. And finally, number 9, will you or an associate be the one working with me?
Yes. You need to know if you're hiring the star of the firm or if your account is just going to be passed off to a junior planner right away.
That list is your foundation. Okay, so now we move on to step 6, which is verifying everything they just told you.
Vetting for trust and safety beyond just the interview.
Of course, referrals from friends and family are a good start. And you can check professional groups that vet their members, like the FPA or NFPFA.
But the absolute must-do, the crucial safety check, is using FINRA broker check.
What is that exactly?
It's the official regulator's database. You can type in any advisor's name and see their employment history, their licenses, and most importantly, any disciplinary actions or client disputes.
So if a potential advisor isn't in there, or if they have a long history of complaints?
You walk away, period. The sources are very clear on this. It's the ultimate background check for the industry.
And we need that check because, sadly, fraud is a real thing. What are some of the other warning signs people should look out for?
A big one is if they claim to have some kind of special, unbelievable credentials, or if they use a lot of high-pressure tactics.
Like, this is a limited time offer, you have to invest now.
Exactly. Sound financial planning and urgency just don't mix. Another huge red flag is anyone offering guaranteed or ridiculously consistent returns that don't match the market.
If it sounds too good to be true.
It is. The market goes up and down. Anyone who says they can beat that is selling snake oil, not advice.
What else?
If they're unwilling to explain an investment, how it works, what the risks are, or if they promise huge profits from a tiny investment. And a really practical one.
Yes.
Never, ever write a check directly to the advisor personally. It should always be to their firm or a licensed third-party custodian. If they ask for a check in their own name, run.
That is a massive warning sign. Okay, so after all of this, the goals, the credentials, the fees, the questions, the background check, we come to the final question. Is it all worth it? Is an advisor worth the cost?
It completely depends. If you've already mastered the basics, you're saving 10 or 15% of your income, you're consistently investing in low-cost funds, you're keeping debt low.
And your financial life is relatively simple.
Right. Then you might not need one. You can probably manage it yourself.
But
if you're just starting out and you need that solid foundation built, or if your life has gotten complex, you have stock options, a business, inheritance questions, then an advisor can be more than worth the cost.
the mistakes they help you avoid could be worth far more than their fee.
Many times over. The tax savings, the strategic planning, the peace of mind, it all adds up.
So to wrap up the mission here, focus your search only on transparent advisors.
Ask those 9 questions.
Use FINRA broker check, no exceptions.
And find a fiduciary, fee-only advisor who is committed to putting your interests first. That's how you turn this anxious search into a really confident decision.
It really is about giving you the tools to approach this not as a novice, but as an informed client who's ready to protect your own future.
You get to walk into that conversation as an equal because you know exactly what to ask to reveal their integrity.
And that brings us to our final provocative thought for you to think about. Given this crucial difference between how advisors are paid and the standards they follow, how would you react if you found an advisor you liked, but they refused to sign that simple one-line fiduciary oath? They'll sign the client agreement, but not the oath.
What does that hesitation really tell you? What part of their compensation structure might they be trying to protect by not putting that promise in writing?
Something to keep in mind as you start your own search.